So welcome to Flippin SoFlo. I have a good friend of mine, Jason Hartman here. The hot topic today is obviously interest rates, what the Fed has done, what COVID did, the consequences that it left behind. I'm a numbers guy. That's my background. So I come from a finance background. So obviously I know that we're just kicking the can down the road per se with everything that we've done, but I'd like to get your input, go over some statistics, inventory, how bad is it really? Right. And it's all relative, right? Because people are throwing out all these figures and everyone's getting involved and the doomsday scenarios and this and that. But you do have to say compared to what, right?
Yeah.
And that's really what data matters, right? Are we high? Are we low? Yeah, it depends compared to what, right? And one of the reasons why I wanted to do this show with you, number one, is you're super in tune with the data. And it's not drama, it's data, right?
Yeah.
And that's one thing that I always picked up from Mark Evans, data, not drama, right?
Yeah.
And,
I
and,
like
and
that.
I agree with it very much. I always say that because data makes things relative. And yes, do I believe that we have some issues? Yes, we printed way too much money. We floored rates, in my opinion, a little bit too late. Then, as always, as the American economy and as human nature goes, the pendulum swings extreme right and then it swings extreme left. And then we're always playing catch up. And I think you touched on this in your mastermind, but I'm always saying this. The Fed really it's an archaic style of a system.
Oh,
And the
sure.
way that they read
Yeah.
data is in arrears, but it's not real time as it should be. And
Right.
I always say, if I ran my business or you ran your business the way that the United States government runs theirs, we'd be bankrupt.
Yeah.
Right? They don't play by the same rules.
Right. But they don't have to because they can
Of
print
course
their own
not.
money. Okay. So, they don't have to play by our rules. But one
Exactly.
one thing is for sure. Look at we have created all sorts of new currency units. So we have now a massively increased supply of dollars chasing a still limited supply of goods and services. So what are you going to get? Inflation, always, right?
Of
Always
course.
and everywhere. Inflation is a monetary phenomenon, Milton Friedman said. Some people try to debunk that, but basically at the end of the day, he's mostly right. Okay.
So everyone looking at this chart right now, just take a look at it, right? I know there's news versus noise. That's what I always reference to. A lot of the noise is what the media has ran away with and will put in your face, like 7% interest rates. Oh my God, this is the highest it's ever been. Oh my God, affordability, this and that. While some of that may be true, because there is less affordability today than, say, 18 months ago, for example, that is true numerically. But if you look at a chart like this, look at the amount. There's 65% of home ownership or mortgages that are 4% or lower at
Yeah.
interest rates, which
Right.
is a big positive towards the grand big picture.
Yeah, it definitely is. It definitely is. It's positive for owners and potential sellers. It's negative for buyers.
Correct.
Okay. Yeah. Okay. So let's talk about inventory levels. Okay. Basically, what we have right now is we have about 465,000 homes for sale in the United States.
Currently.
Compared to what?
Correct.
Okay. So during the most savagely difficult housing market we've had in decades, when inventory was the lowest it's ever been, we had about 245,000 homes for sale. I believe that was the bottom in terms of number of homes for sale. But what is considered normal? What is a normal market in quotes? It's 1.2 million homes. So if you look at the market, I like to use a sink as the metaphor. Like think of your kitchen sink, okay?
Mm-hmm.
And new homes coming on the market, new listings, that's the faucet. That's the water coming out of the faucet. How much is coming out? Okay. The water in the sink is the existing inventory. Okay.
Okay.
And that's the 465,000 homes. And we're going to say if the sink was full, that would be a normal market. All right. And then the drain. What does the drain mean? The drain is the buyers. That's the absorption rate. That's people buying the properties on the market. It's taking the inventory away. Okay. So what did we have before? Well, before we had a faucet that was trickling and the sink was about 25% full and the drain was open all the way. As much inventory came onto the market, it would just get sucked out. People would just buy everything, right? They'd buy everything they could, bidding wars. It was crazy. Then they raised interest rates. They almost tripled mortgage rates. Okay. And you've got to just think real estate must be the most resilient asset class on planet Earth, that it could withstand tripling interest rates almost.
Agreed.
And prices year over year, here's the big crash, folks. Housing prices year over year have gone down by about $4,000. Yes, like nothing. It's a complete nothing burger.
Yeah.
It's like a drop of water in the ocean. It's nothing.
Yeah.
That's the crash.
Yeah, 4,000. And again, you said 4,000, correct?
$4,000, less than 5,000.
Right. So let's say $4,000 in South Florida, specific to my market. You live in Palm Beach. Dude, the average median price right now is 450.
Oh yeah.
So what's 4,000 out of 450? It's not even 1%. I mean,
I'm surprised it is 450 where you live. I think it'd be higher than that, but okay.
Yeah, and again, I'm probably off because I'm being conservative about it.
That's not one of our markets. You know, we don't do business in high-end markets because they don't make sense for rental. We do business in entry-level markets where houses are cheap and they're entry-level housing that make good rental properties. So I don't really know your median price in Fort Lauderdale, and I don't even know mine where I live in Palm Beach. Okay, I don't care. You know, that's not my market. My market is places like low-cost markets in Alabama, Florida, Tennessee, Texas, Arkansas, Indiana. These are the markets we love. We love these markets. Okay. And
what about Ohio?
Ohio's good too. Yeah. Yeah.
And just for the viewers, in your business model, like in those entry level markets, what kind of return can an investor expect average?
Well, it depends, of course,
Sure.
But overall returns, like if people look on my website and they go to jasonhartman.com, they get full page pro formas when they click on the properties section. They can just surf around, check it out. You know, there's no cost to enter or anything like that. And they can see full page pro formas with all of the numbers on a property. And typically these properties will perform with an overall return on investment of 20 to 33% projected, right? Nothing's guaranteed except death and taxes. But I always say, even if it only goes half as well as expected, you're going to make what, 17%, right? That's pretty good. Now, a lot of people think, oh my God, that's just total hype. No, it's not, because you don't know how to do math. Okay. This is why income property is the most historically proven asset class in the entire world. Everybody, if they didn't get rich themselves with income property, they certainly know someone who got rich with income property. In fact, they probably know dozens of people that did that, right? Why do you think that's true? Why do you think you don't know a bunch of people that got rich in the stock market or buying gold or even buying crypto, right? Because income property is a multi-dimensional asset class and you earn your return in lots of different ways. Most people, you know, they look at like one-dimensional investments. Okay, buy low, sell high. That's the whole game. If it's, say, a dividend-paying stock, buy low, get some dividends in between, sell high, right? Two-dimensional asset, right? Sure. Precious metals, buy low, sell high, one-dimensional. Cryptocurrency, buy low, sell high, one-dimensional. Now, I know with crypto there are like these creative things, but most of those have turned out to be scams and those people are on bail or in jail, okay? You know, but I know there are things you can do with crypto. I'm quite well aware, but you know, we only have limited time, okay? Basically, the asset is buy low, sell high. That's mostly the trade. So in a multi-dimensional asset class, you just have so many ways to make money from it. And that's why the return is so much better.
But again, I mean, I hold real estate. I'm sure you do as well.
Oh, of course.
You have tax depreciation, you have bonus depreciation, you have appreciation.
You have appreciation, depreciation, leverage, tax benefits. You have forced appreciation where you can fix up the property, or you can just not even fix it up, but you can re-engineer the way you do the property, right? You can put your tenants on a rent-to-own program, lease option it. You know, you can refinance it. I have a whole strategy called Refi Till You Die, which you can go to jasonhartman.com and check that out. Refi Till You Die. Just type it in the search engine there. There are just so many ways to make money with income property.
It's insane. It's insane. And again, my background coming from the Merrill Lynch world, stocks, securities, equities, they don't provide any of that. Like at best, like you just said, you get a dividend. That's it. But you can't depreciate a stock. You just can't do it.
And it has terrible tax treatment too.
Terrible cap gains. I mean, terrible. Yeah. And then with real estate, over a year is considered a long-term gain, no longer a short-term gain. So again, if you're listening, we're not talking about fix and flips. Fix and flips have higher tax brackets. You do not get tax, bonuses or anything like that. We're talking about if you hold and you hedge with buy and hold rentals.
Right. So if you're a home flipper, and I know that's a lot of your audience, what you should be doing is you should be flipping homes, and that's your business. And then you take the money you make from your business take your living expenses out of it, and the rest you buy long-term buy and hold properties. That's the dual strategy that works. Flipping homes is just a business like any other business. I mean, you could have a big corporate job and make money there, right? So you make your money there and then you invest it here. This is investing is what we're talking about, not running a complex business that requires a bunch of your attention. So anyway, that's the thing. Income property is the most tax-favored asset class in America. Taxes are the single largest expense any of us have. So very important to save on taxes. Okay, let me show you another chart. Remember what I said earlier. If you want to have a real estate crash, you've got to have a bunch of desperate sellers. Mm-hmm. Now, this chart is showing the distribution of all the existing mortgages out there and what their loan to value ratio is, the LTV. In other words, how much equity do they have? Or how big are their loans as a percentage of the value of their houses? Okay. What we saw leading up to the Great Recession in 2008 is we saw a whole bunch of people that had no equity. They had no skin in the game. They had no incentive to stay. Mm-hmm. As soon as things get bad, they just walk away, right? And so here we see that in the blue, a giant chunk of the market that has massively increased in the past 10 years has less than 60% loan on their house. They have over 40% equity. Here you've got another cut of people that have 61 to 70% mortgages, okay? And that's another huge cut. But the people that have like 91 to 100% mortgages or over 100%, meaning they're underwater, it's nothing. Can you even see that on this chart? I don't know if you can even see this little red.
You got to zoom in big time.
Yeah, you can't even see it. Okay. Yeah. So it's a very small number of people that could get into real trouble and have the walkaway syndrome. So let's look at their credit scores.
Not 07, 08.
It's definitely not that. Okay?
Not even close, because there's liquidity is what Jason's saying.
Not even close. Okay. Now look at this. This is their credit scores. Okay, we looked at how much equity they have. We talked about how low their rates are, right? We did both of those things. They have very low rates, very affordable mortgages. Some of them have no mortgage at all. But if they borrowed money for the 58% of the people that actually have a mortgage, what is their credit score? How good of a borrower are they? What's their history like? Well, 760 plus FICO scores. Look at how many people have 760 plus FICO scores.
Massive. It's massive.
And this is quarterly. This is the end of the first quarter of this year. This is the end of the first quarter of the year before and the year before. And we see that all of these people that massively refinance, these tens of millions of people that refinance their homes during the COVID era, their credit scores are insanely good. These are not ninja loans, no income, no kids, no credit, whatever, right? These are like really golden borrowers, okay? Sure. Now, let's look at the low end of this. Let's look at people, 720 to 759, that's still a golden borrower. Then we go down to the most people have a credit score in this range, 660 to 719. That's the country, but it's not the mortgage holders. It's not the borrowers. There's only a small number of them, okay? And then lower than that, there's hardly any of those people. And then people below 620, can you even see that on the chart?
Not much.
Like it's nothing, okay? Yeah. But look how it was back leading up to the Great Recession, right? There were lots of those people. There were more people with bad credit back then than there are now. Like all the people now, the borrowers, I mean, anybody who got a mortgage in the last, 15 years knows that you had to give a DNA sample. They wanted to know your shoe size. The underwriting guidelines were insanely difficult, right? Yeah. So it's just a completely different market, right? Population growth is another thing to look at. We've got the largest generation in American history right now, the millennial generation, who have been very slow at getting their act together. Millennials get a lot of criticism for that. They're about 6 years behind prior generations. They didn't get married very quickly. They didn't buy a house very quickly. They didn't want to take on responsibilities very quickly, but they're about 6 years behind. But now they're finally in the stage where they're doing that, okay? Yeah. And that represents 80 million people. Now, everybody talks about the baby boomers, right? Because they were the largest demographic cohort in world history. Not just American history, but world history. And when they moved through the economy, they created massive amounts of prosperity with their spending, their productivity, all of that. That was only 76 million people. That was 4 million smaller than the millennials. So the millennials have finally grown up, and now they're forming households, and they're getting married, and they're doing all that stuff, right? And a lot of people look here and say, oh my gosh, 2020, this is the population growth. It's way down. So that means there's going to be less demand for real estate. And you're right. As soon as you take this and lag it by 25 to 30 years, you'll be right. But right now we have to lag backwards, and we have to look at what happened 25 to 30 years ago. And there was a massive population explosion back then.
Yep.
And all those people need houses, and there aren't enough houses for them. So they're either going to rent or they're going to buy. Look at the immigration levels through the roof, okay? Number of owner-occupied housing units, hardly gone up. This article is good. Inflation-adjusted home prices are still 3.6% below the peak. Wow. Everybody thinks housing's so expensive, huh? Well, the last peak during the bubble time, leading up to the Great Recession, housing prices were 3.6% more expensive than they are now.
Right.
Okay? And we had a completely different set of circumstances. We had overbuilding, high inventory
with
levels.
With subpar borrowing too.
Yeah. Totally. Yeah. Ridiculous borrowing. It was terrible.
Yeah.
But here's maybe one of the most important charts I'm going to show you. You see, I titled it The Most Important Charts. Because this one's really important.
It's dummy proof.
Yeah. This shows us that in 2005 era, give or take, we had a massive building boom. And coming out of the Great Recession, we have hardly built any houses. 13 straight years of construction that's below the 50-year average, yet the population had increased a lot during that time.
Why do you think that is?
Well, because builders were scared and lenders were scared coming out of the Great Recession. They were gun shy. Okay, the lenders didn't want to finance the projects. They were just worried. I mean, and rightfully so. So they didn't build as much. Another saying I have besides compared to what, that I'm always saying on my show, is you can't hear the dogs that don't bark. Okay? So when you look at this chart, which is incredible, what dog isn't barking? What doesn't the chart tell you? Well, what it doesn't do, and none of my data does so far today, at least. I have other data that does this, but none of it today has talked about segmenting by price or geography, okay? And what I can tell you is that everything we've talked about represents the entire market in the entire country and every price range, okay? It does not represent entry-level housing. And virtually none of that has been built in the past 15 years, like virtually nothing coming out of the Great Recession. So you see here that overall construction is way down, but this is really, really acute, Will, in the entry-level housing category, which is the place we investors like to invest. We like these cheap entry-level bread and butter houses because they have the best rent to value ratios, and they are extreme shortage. I mean, like we talked about the overall shortage, we only have about 35, 40% of the number of homes we need for sale to be in a normal market, not a bad market, just a normal market. But in the entry-level housing market, that is just massively undersupplied. Why? Builders can't make any money building it. If there's just no profit margin in it anymore, okay? So this is going to carry forward for a long time to come. And if you buy those properties, you are going to have the asset that is very scarce and that everybody wants.
If I'm hearing you correctly, you're saying, contrary to popular belief, right now might be more than likely the best time to buy in comparison. If you look back 10 years into the future and you look back to today when you and I are talking, we're probably going to say, damn, I wish we bought more, is what you're saying.
Not exactly.
Okay.
This is not the best time to buy. The best time to buy was during COVID. It was in 2020 when you could get extremely low rates before the prices went up, right? Although there was hardly anything to buy, but that would have been better, okay?
Yeah.
Look, there's an old saying, when's the best time to plant a tree?
Yes.
20 years ago. What's the second best time to plant a tree? Today. Okay? You just got to do it. Everybody's got their rationalizations for this, that, or the other thing. There's this category of people that, when it comes to the real estate market, we call them the crash bros. Okay. These are the people hoping there's going to be a crash, right? They keep waiting for the crash and they keep missing it because it just never happens. Okay. It happened 15 years ago, but it hasn't happened since. In 2012, they said it was going to happen because we were 4 years out of the Great Recession by then, and it didn't happen. It just went steadily up. In 2016, they said it was going to happen. When Trump got elected, they said it was going to happen. When Biden got elected, they said it was going to happen. When COVID hit, they said it was going to happen. They always say the crash is coming. Just look at the freaking data, okay? Look, they will be right someday. They're just not even close to being right now, okay? Now, look, there's a lot of geopolitical stuff in the world that's pretty unstable. I mean, the war could escalate in Europe. It could spread. We could be into another world war. God forbid, let's hope that doesn't happen. I mean, I don't know. Yeah, that would change my mind. But I could tell you, even if we were in World War III, depending how bad that got, let's hope it never happens. But if inventory is low and population is increasing, we got a housing boom. I mean, there's upward pressure on housing prices. If inventory is high, population is decreasing, demand is low, that's a crash.
Well, that's the one thing, during COVID, myself included, I've been in the business for 3 years as a wholesaler and a fix and flipper. When COVID happened in March of 2020 till about June of 2020, I'm sure you remember, it was that funky, wacky time where the whole world, well, I'm not buying, well, I'm not selling, well, we can't show the property. Lenders were backing out, appraisers, this, that, the infection and the mass and all this crap. And dude, 6 months later, I couldn't get my hand on enough real estate. And then a year later, it was like twice as much.
There's a weird thing in psychology with these crash bros, and I've just noticed it because, people accuse me of being the Perma bull. They troll me on YouTube and, just tell me how wrong I am all the time. Yet I've been right and they've been wrong, right? And these people they're like the guy that sees the pretty girl and doesn't get the nerve to talk to her, right? And then he misses out. Right? He missed the opportunity to meet the girl, right? And because of that, he will then start rationalizing. And listen, I've done it. Okay. So I know this guy. Okay. He'll start rationalizing, say, she wasn't that good anyway. She's probably messed up. She's probably got a boyfriend, whatever, right? All these rationalizations come into play, right? And people are great at rationalizing their own lack of action. And that's what the crash bros are. They've missed out over and over and over again because they have no self-confidence. They're basically wimpy people who have no guts. And they try to displace their fear and their weakness onto other people. And they're just wrong. Just look at the data, okay? The data is the data, right? It's there. It won't always be the data. Hey, there will be some time if we do a show a year from now or 10 years from now, I might say that there's, inventory is way oversupplied. The sink is overflowing in my metaphor of the sink, right? And the faucet is on full blast. There's lots of new homes coming on the market and the drain's plugged up and sink is overflowing. That's a bad market, right? That'll be a crash. We're just not even close to it.
We're not.
It'll come someday. I'm not saying it won't ever happen. Of course it will come. There are cycles.
It's all cyclical. And again, for anyone listening, statistically speaking, every 10 years, the housing—
there's an adjustment. Sure. Yeah.
Goes through it. So it takes about 10 years if you look back at the last 100 years.
But we've been going for 15 years now.
I know we're already 50% or 150% past that.
Well, I think one of the issues with the business cycle theory, which is a valid idea, right? That there's every 10 years there's going to be a little bit of a downturn, a little bit of correction. Maybe COVID was our correction, right? Because we did have a little recession there, right? But because the Great Recession was something that was a lifetime event, right? It took 70 years to see an economy that bad, that we started at such a low baseline coming off of the Great Recession that it took till about 2012, 2014 to sort of get centered again, right? And that should be the baseline, right? So maybe that's the way you have to kind of look at that business cycle. I don't know. It's just an idea.
Look, for me, and I know for the interest of time, I want to get through some pretty key questions here, if you wouldn't mind.
Fire away. Yeah.
To get your input and answer them to the best of your knowledge. But
sure.
Given everything we've just talked about, everything that we do see, the real market where we're at today, where do you think— no one has a crystal ball, but where do you think this goes from here? And then a second question, which kind of ties into that one: What do you feel is going to be the catalyst for that to happen? And we'll start there.
Yeah. So look, people only have three choices. They can buy, they can rent, or they can be homeless. And as investors, remember, most of the focus is on how many buyers are out there and what does that mean for prices of properties. Okay.
Okay.
But so what? Assume that I'm completely wrong about everything and assume prices go down. We still have a limited supply of housing. We still have a shortage. And if prices do go down, all the people that are the would-be buyers will then rent. So what? I mean, that's the great thing about being a buy and hold investor. Sometimes you're milking your assets for yield, just rent, cash flow, return on investment, and sometimes you're milking them for capital appreciation. It's either one. You don't get away from the hard fact that the population is X and the supply is Y. That's it. Like it doesn't matter what the economy is doing or anything else, right? There's more demand than there is supply. End of discussion. Okay. So they're going to rent it, they're going to buy it, or they're going to be homeless, right? That's it. There's no other choice. Okay.
Yep.
So
and that's definitely taking the emotion out of it.
Yeah. So that is a floor. That sets a floor on how bad it could get to some extent, right? Certainly more people could become homeless, right? But the reality is most will just move down the economic ladder. So that person that's renting your $300,000 entry-level house will have come from a $450,000 nicer house, and you'll catch them on the way down. Okay, great. If things are booming, you'll catch people moving up. Either way, you're going to win. So that's one thing. Where do I see it going and what's going to be the catalyst? Well, one thing that definitely concerns me is that we've talked all about real estate and we've talked about all these people with their very affordable mortgages. But what we didn't talk about is how inflation is affecting them outside of real estate. Insurance premiums increasing, inflation in general, food is a lot more expensive. And this takes a toll on the average household, right? So no question, they are being squeezed and the middle class is being hollowed out, sadly. My mission in life is to help people move from the middle class up so they don't fall down, okay? Unfortunately, a lot of people will fall down and have already fallen down. And I think you need a big middle class if you want to have a stable country, and the middle class is just sadly being eviscerated. I think the catalyst is just continued pressure on people, on households, whether they're renter households or owner households, doesn't matter. They're all feeling the pressure, and it's getting pretty bad.
Perfect. I agree with you. Next question is, the Fed meets in July. I have my own opinion. I believe that they're going to stay on this one. I don't think they're going to do any change. That's just my opinion. There's a number of reasons for that, but what do you think they're going to do?
Well, I have to tell you, in my 18 years or so on the air as a podcaster, and this is the great thing about me, you can just go listen to my old shows. They're still there. Right. You can listen to show number 1 and you can hear what I said in 2004. Okay. And my predictions have been fantastic on virtually everything except interest rates. So don't ask me about interest rates, man. I thought the Fed would stop this craziness 2 hikes ago, and yet they hiked both times. Some feel they may do it one or more times. Some feel they're going to either just let it be or pivot and start bringing. I don't know. I don't think they're coming down at the next meeting. I'll put it that way.
No,
it's one of two choices. It's going to be just stay the course or another quarter point bump. God forbid. Yeah. I hope they don't raise it again. But
I appreciate the honesty because most people would have just bullshitted their way through that. So
interest rates are super hard to predict. Probably the foremost expert on that, there's a newsletter called Grant's Interest Rate Observer, and that's probably the best source.
Okay. Yeah. Look, my opinion is I've been pretty good at predicting them. I've said hike all the way. I didn't think. The one difference was I really didn't think that they were going to do 75 basis points at one point.
Yeah,
He did. That really worried me. And you saw the jolt into the economy. This is very interesting to me. The news has, kind of hidden under the rug the fact that there's been multiple banks that have gone under. And that is one indicator that the Fed is breaking things. I'm not saying whether it's right or wrong. I think the Fed's job is to break things in some degree.
Absolutely, you're right. No, that's
what they're entitled
to. Yeah, yeah.
Exactly. And again, I feel there's more to come. I think that there's a big catalyst waiting to happen with office and retail.
Yeah, those are going to be bad. Those are a bloodbath.
Yeah. Yeah. I mean, you can see it. It's starting to come in. But I think that's, as you know, being in this business for so long, chaos creates opportunity as well. Yeah. Right. And there's going to be a ton of opportunity there. So any final words for any listener, somebody starting off in this business, wholesale?
I would just say minimize your exposure to the fear porn. Sensationalism has always been the thing that captures attention. Clickbait titles have always captured attention. And whenever you're listening to someone out there, always ask yourself, okay, what they said is really interesting, and that makes a lot of sense. But what didn't they say? Okay, sometimes the most important thing is what's unseen, right? The dog that didn't bark. And that's what you've always got to ask yourself.